On the one hand, you have a $250,000 debt at 7.5% interest. On the other hand, you have a $750,000 house that only has to average 2.5% growth. As long as it appreciates at least 2.5%, it's the same percentage of equity. So what happens down the road? It depends. If the house appreciates more than 2.5%, you're going to have more equity. If the house appreciates less than 2.5%, then you're going to start eating into the equity.
Welcome to Get Real 411, the podcast where real experts give real advice on all things real estate. I'm Jamie.
And I'm Brad.
Join us as we explore real estate successes and pitfalls through the eyes of our esteemed guests.
Now let's get real.
We are super excited to sit down today and talk with Jeff Foody from Northwest Reverse Mortgage. Jeff, thank you so much for being here today.
Thanks for having me. I appreciate it.
We have really enjoyed, getting to know you a little bit more. And one of the reasons that we wanted to talk with you today is because it's really impressive the way that you have built your business solely focused on reverse mortgages. And so I would just love to kick it off by hearing a little bit more from you about what led you to decide that reverse mortgages and this particular subset of our community, our seniors, were the client base, and this was the loan type that you wanted to devote your career to.
Gotcha. That's a good question. Okay, so I started out when I was in college. I got suckered into I should say suckered in, but I think it's a pretty appropriate term. I got to working for one of those like multi-level marketing financial service companies, right? And I was 21. I didn't know anything, but I was actually really good at it, and I'd made some pretty decent money at it, and I had two business partners, and we were making pretty good money for being in a little college town, and one of us had the brilliant idea of moving somewhere where people actually had some money. So we moved down to San Diego, and I thought, oh, this is it. We're set. We got in a relationship with a guy who owned a couple of Jackson Hewitt tax services, so we could sit in their office during tax season. And man, we thought we had it down, and then found out that we're 20-something-year-old kids trying to tell people what to do with their money, and there was we had a couple of brick walls, and so we didn't do very well when we moved down there. And my wife found out she was pregnant with our first kid, and then we kind of realized that, hey, it's time to get a regular paycheck, and this commission only thing isn't working. And so we my two business partners, I decided we'll look around and let's see some place that the three of us can work and get regular jobs, and we can build our company up on the side or whatever. And anyway, we went to this reverse mortgage company that was hiring processors, and they would hire all three of us and they would train us. And I said, well, that's cool. The three of us can stay together and get this gig. And so we went in there. My first question is, what the heck is a reverse mortgage? And in our financial services background, a lot of what we talked to people about was retirement planning, was about looking to the future, about the fears of trying to live off of Social Security, but all of these great investments, and homes being great investments, and equity. And so when this guy's sitting down talking to me about what a reverse mortgage is, I just had light bulb after light bulb just popping off in my head. And I was just seeing into the future. And I realized this has been 20 years now since then. And I remember seeing this and hearing about this. And I was like, this is the wave of the future. I'm like, we've got this huge demographic of baby boomers hitting retirement, trying to live off of Social Security, which isn't enough to get by, but they've got all of this equity in their homes. I'm like, this is the perfect fit moving forward. And so, I got hooked right then and there. I started out as a processor, just helping do the files, and I realized that I'm really, really bad at processing. But I got to know the loan officers, and I could kind of see their perspective about it. And so I was trying to work operations and help them figure out ways to get the product, to make the product better for our operations. So I kind of got into the operations side of it, and I got into training loan officers. And then after a while, after doing that for a few years, I kind of found a little niche where I was doing consulting, where companies that were interested in doing reverse mortgages would hire me to come in for a couple of months and I would create a reverse mortgage division. I'd put together processing manuals, and I would train the loan officers, and I kind of get them, kick-started in it. And then I would, leave after a couple months and go do that somewhere else and do that somewhere else. And one company said, I went in there and they said, "Hey, we want you to stay." I mean, they made me a really good offer to stay, and we're like, "You've got to create this thing for us." And it was huge. We built out a company that I think we're doing. I think we were doing about 1,500 a year, and we were, nationally licensed, and we were a big brand name. I think we were the 7th top producer at the time, and we were, doing awesome with it. And that was about 2008, 2009, where the Ford Mortgage Company collapsed, and our parent company was a Ford Mortgage Company. So anyway, um, I decided that's when I got back into originating. At that point was I've kind of a varied background of the reverse mortgage side of the industry. Like I tell people, there's really not a whole lot of part of the industry that I don't get, because I've done processing, I've done operations, I've done origination, I've done administration, I've done, I mean, you name it, I've kind of run the gamut on all of them. But I kept coming back to the originating because honestly, as much as the administrative part of reverse mortgages appeals to me because I understand the industry and I understand the product and I understand mortgage companies, I still get a kick out of selling. And I always kind of get that little dopamine rush when a person says, "Okay, let's do it." I've never been able to get away from that. I really do dig originating. And I always get the feel for, I've actually got a closing today that I've been working on for 2.5 months. It's just been long, and it's been drug out. And this person was just at their wits' end. They didn't know what else to do. And now we're completely changing the nature of his entire financial situation. And being able to have him sign on the dotted line and close and cry and be, "I can't believe we got here, and this is going to make a difference for my family for generations." And I'm like, it was huge. And so there's still that takeaway that you get from it. I don't know how. I don't do traditional mortgages. I've never done a traditional mortgage ever, and I don't know. I guess you'd have to compare it to maybe like a first-time home buyer, where you get that level of satisfaction. You know what I mean? But as far as like, the traditional refinances, and you're just kind of, burning through your same clients that you've done 2 and 3 and 4 times, you've got the relationship over years. I don't think you get the same satisfaction. Whereas here, you're like, man, I at the end of every day when I close a loan, I can sit back and say, I know I made a difference in their financial situation that will last them the rest of their lives. And there's that gratification that comes from it. So anyway, that's how I got into it, and that's kind of how I've stayed in it. Is I still kind of have that. I'm a loan officer. I like selling. I like getting out into borrowers' homes. I like making a difference. I like being able to look back at the end of the day and say, "Man, did I do something good today?"
Yeah, Jeff, look, you can tell right out of the gate, you've got a very deep passion for what you do. And I can relate to it because, as we've talked about before, my roots are in origination. And I started originating reverse mortgages in the 90s, when things were quite different for those. And I know you've been doing it since 2002. And even at that time, there was quite a bit of difference to what the product is today. But I think what would be really terrific, because you are entirely reverse, and you're one of the top producers of reverse mortgages in the nation, it would be great to hear a deeper perspective from you, not only superficially on how you change people's lives, because you do. I mean, that is really the truth. It makes it much less expensive than anything else you would do to live out your golden years just by going into a reverse mortgage. You couldn't rent a home, or you would go through your equity, and it just there's no better product for entering your golden years, being house rich and everything else poor. This is the perfect solution. But there's also a lot of fear out there that has lingered on for years, even though it's really unjustified. Maybe you could talk about that for a minute, but then maybe even just more details about it. Like, what does it take to qualify? Who should consider it? How old do you have to be? Do both spouses have to be that age? I think just getting into some of those guidelines, if you will, I think will help our audience understand when this might be good for them, or for somebody they know, or for parents or grandparents. I mean, having those details, I think, would be really beneficial, since this is second nature to you.
Sure. Yeah, maps. Those are great. So let me try and remember to cover as many of those questions as I can. And if I missed one, come back and ask me again. And I'll make sure I get it for you. But um, a little historical context, because I think it's helpful to know, the reverse mortgages prior to about 2014, they were kind of a loan of last resort, right? Most of the people that took out the loans were people that were a little financially destitute. I'll give you an example. I just talked with a guy about 2 hours ago. Um, Lives off of $2,000 a month in Social Security, makes $1,100 a month in mortgage payments, and he didn't want to do a reverse mortgage. We talked for an hour and a half, and I pulled up a Zoom and I was showing him figures, and so that he could see everything right, because he didn't see how a negatively amortizing loan was a good financial strategy. And so I was going through the numbers and I was pulling up. I'm like, okay, so here's how much the closing costs are. Here's what your interest rate is after year one. But there's still your home's still appreciating in equity. Here's what this looks like after year one. After year two, here's what your net benefit looks like. Yes, it accumulates $15,000 in interest in year one, but at a 4% appreciation rate, it grew $19,000 in interest. And kind of just and then showing out a year by year amortization schedule. And at the end, he was just like, he's like, listen, Jeff, I appreciate your time. He says, you got to understand, I'm a child. He's like, I was a child of the Depression. We just learned how to just get by. And he said, I used the word struggle. He said, I'm used to just getting through, and I can make my mortgage payment, and it's tight every month, and I dig into my savings a little bit each month, but it's just a struggle that I'm used to, and it's a struggle that I'm comfortable with. And I'm like, well, I understand this is a different concept. That's probably the majority of what the early reverse mortgages was they were people that just figured they were financially destitute. They didn't care about the closing costs. They didn't care about the interest rate. All they cared about was no more mortgage payments. And it created kind of a subprime feel to the reverse mortgages, because then you paid a 2% mortgage insurance premium. You paid a 2% origination fee off the appraised value. So if you've got a $500,000 house, you're looking at 10 grand for mortgage insurance, 10 grand for origination fees, $20,000 in closing costs, plus the third party fees. It was ugly. And at the time, they'd qualify for like 75% of the value of their house. And they took all of the money out in a lump sum and accumulated interest on all of that from day one. It didn't take long before it ate up all of the equity. Right. So there was a lot of people who after they passed, there wasn't a lot of equity left in the homes, because they were getting 75% of it in a lump sum, right? So 2017, FHA made some changes to the program. And so 2014, they made some more in 2017, and it completely changed the structure of the reverse mortgage. Now, instead of qualifying for 75%, they're qualifying for closer to 50%. And instead of having to take all the money out in a lump sum, they can take monthly payments. They can take a line of credit. They can leave it in the line of credit. There's this financial flexibility on how to take the proceeds. They didn't have to take everything right away, and it didn't accumulate a ton of interest from day one. And so that made it so that there was more equity left in the home. And over time, the probability of eating up into the equity was very, very small compared to what it was previously. And so it kind of changed the structure of what reverse mortgages were from about 2017 to about 2021, 22. Reverse mortgages were a financial strategy at that point. Like, it wasn't just the loan of last resort. Now, I teach CE classes to financial advisors, to CFPs, on how using a reverse mortgage with a line of credit can help sustain the borrowers financially over the rest of their lives. When to take money out of their nest egg, when to take money out of their equity in their home, how to use it simultaneously. We use it a coordinated withdrawal strategy. And all of a sudden, it's this viable financial piece to the reverse mortgage. And that's really what it had been from, like I said, from about 2017 to about 2021. It was this financial strategy. I teach CE classes for realtors on how to use a reverse mortgage for purchase that they had never even considered, previously. And so now a borrower, if they want to buy a $700,000 house, instead of, cashing out all of their equity or taking out, a huge mortgage and having a mortgage payment, the reverse mortgage can be that tool that can help them buy the house, and they don't have a mortgage payment. And it just completely blew their minds about how this works for the senior demographic. Now, more recently, when I say I mean within the last year, The market's kind of changed back to what it was previously. The product hasn't, but the market has. Because the interest rate is now higher, the amount of money that borrowers are qualifying for is decreased. So now the people that are doing reverse mortgages today, most of our new applications are people that aren't using it as a financial strategy. They don't care about the line of credit as much. They don't care about what are they using for the extra money for their equity. They're just trying to get rid of their mortgage. That's kind of what most of the applications are today because the rates are high. And they're saying, well, I don't care about the rates. I just got to get rid of my mortgage. So now we've kind of changed the market back to people that are kind of more financially destitute. So now my marketing effort from an originating perspective, I still have the referral partners, which is still always going to be the meat of my business, but more of my direct marketing efforts, direct to consumers, are back to that clientele of people that are falling behind on their mortgages, or people that have big mortgages and small interest and small incomes, and they're trying to figure out a way to make it work. And there's more of an immediate need for the reverse mortgage, and so that's kind of changed our marketing perspective in the last year. That's kind of where we're at. Now, as we start to see the interest rates get lower back to what reverse mortgages usually are, it'll go back to that financial strategy. So crossing my fingers and hoping that we get to there sooner than later. But that's kind of changed the strategy a little bit. I don't know how many of those questions it answered.
Look, no, that's all great information. And, although, yeah, as you put it, the financially destitute or those people that are struggling to make their mortgage payment, it's definitely worth a consideration
Right.
of looking into a reverse mortgage. It goes way beyond that because it's quality of life. If you're just on Social Security or a small pension that maybe even replaces, if you're a public employee and you're on pension, you get like no Social Security. Like it reduces your Social Security. So they make it so that you have to struggle. And even though you might be able to get into a low income apartment or something like that in some cities, like the quality of life is just diminished dramatically. And then you don't have leftover money to go take care of the grandkids or, do something fun or, live, go on a cruise, whatever it is.
Right.
And so it's really getting through to those folks that it's not just about the mortgage payment, it's about quality of life.
Mm-hmm.
I know one of the biggest complaints or issues that borrowers have with this, especially when they involve their children in the decision-making process, is what about the equity? Like, the equities for my kids or for my grandkids. And what do you say to somebody like that?
That's a good question. I'd say, okay, look at it like a traditional mortgage for a second. So this is exactly how I would answer that question. A traditional mortgage. Okay. Let's say you buy an $800,000 house. I know a lot of your audience may be in California, but there are such things as $800,000 houses, the rest of the country, right? Anyway, so no, let's say you have an $800,000 house and you take out a $400,000 mortgage, 30-year fixed, right? You make payments over 30 years. And let's say that you actually abide by the terms. You never refinance it. You never move. You never sell. After 30 years, and you've paid off the balance of the mortgage, how much do you actually make in mortgage payments, right? Way more than double what they originally borrowed, right? They borrowed $430 years ago. They paid back $850,000. In what sense does that make, what world does that make sense financially? Okay, you borrow 400 over 30 years, you're going to pay back more than double what you originally borrowed. The only way that makes any sense is because you acquire an asset. The house was worth 800 grand 30 years ago when you bought it. What's it worth 30 years later? Right? If the house is worth $1.5 million, and yeah, you paid 850,000 on it during that time, but the house appreciated in value. It's the exact same vernacular when we talk about a reverse mortgage. Yes, you have a negatively amortizing loan. Yes, the balance is accumulating interest over time. If the house stayed the same in value over those 30 years, yes, you would eat into the equity. But you can't discount the fact that you still own an asset. An asset is still appreciating and depreciating in value over time. So let's just use simple numbers. Okay, let's say right now a borrower qualifies for 33% of the appraised value of their home. Okay, so $750,000 house, reverse mortgage gives them 250 grand. Okay, so they have 2/3 of the equity still left in the home. They have a third of it as a mortgage against the house. And let's say interest rates are 7.5% right now, and it's accumulating 7.5% interest. You got to look at it like a balance sheet. On the one hand, you have a $250,000 debt at 7.5% interest. On the other hand, you have a $750,000 house that only has to average 2.5% growth. As long as it appreciates at least 2.5%, it's the same percentage of equity. So what happens down the road? It depends. If the house appreciates more than 2.5%, you're going to have more equity. If the house appreciates less than 2.5%, then you're going to start eating into the equity. So it all depends on what happens to the house and what happens to the value over time. So we've got to run amortization schedules for all of our clients. We sit down and say, okay, here's what this loans look like in 5 years or 10 years or 15 years or whatever. And these are all FHA loans. So FHA require us to use a 4% appreciation rate on our projections. So at a 4% appreciation rate, you could have the equity on the interest on the loan be as high as 12%, and it would still keep the same percentage of equity if it's 4% appreciation rate. You know what I mean? So will it eat up into the equity? The answer to that question is depends on what happens to the housing market and what it does over time. I go back to them and I'll say, what was the house worth when you originally bought it? And they'll always laugh or giggle. They'll say, well, it's probably worth about 125 grand when I originally bought it. Okay, well, what's it worth now? Well, it's worth 750,000 now. I'm like, okay, yeah. So over those 15 or 20 years, how much did it grow in value? It's still going to continue to grow in value for the next 10 to 15 to 20 years. All you're doing is instead of making monthly mortgage payments, you're deferring it and letting the payment be made at the end. And you're trusting in the appreciation of the value of the house over the next 15 to 20 years, like you already have for the last 15 or 20 years.
Yeah, I think that last point was probably the most poignant. And that is, what I used to say to borrowers was, yeah, that is true. It is possible that you could live to a ripe old age of 105 or more, and you could owe more on your property than the value at that time, just depending on the time, of the economic times you're in and so forth. However, you're not making a mortgage payment that entire time. And if your mortgage payment's $3,000 a month, $3,500, whatever that is, take $17,000 a year and gift it to your kids now, tax-free. You're giving it to them early. Mm-hmm. They're just, if you think that they need it for their retirement because they're not going to be in the same position you are, then I understand the concern, but take that savings, those payments, and start gifting them the money now. Let them earn interest on it. Now you have that offsetting it because you get interest on that money. So
I didn't even answer. Am I answering your question? I didn't even discuss saving the monthly mortgage payment. Right. All I talked about was just the interest and just the appreciation, like just those numbers on themselves.
Right.
Still makes financial sense without even counting in the fact that, by the way, you're saving $3,000 a month in mortgage payments for the rest of your life.
Well, and if you're putting that savings away today, even in a money market, you're making 4.5% on it. So there's a lot of offset. Right. So it is kind of pulling back the sheets and really looking at things and helping people understand that as a financial tool. But, let's just talk about, because most people, it's a little bit confusing as to what it takes to qualify for a reverse mortgage. Right. How old do you actually have to be? How old does a spouse have to be? Okay. Like, maybe talk a little bit about how much equity do you need, or how much down payment if it's a purchase? How does that work?
So I just got a phone yesterday. I had a woman who just called me. She was looking to purchase a house. She was a realtor, and she had settled with her husband, and she got about a $400,000 payoff. And she's like, well, listen, if I buy a house now, I don't want to buy a $400,000 house because I use up all of my money. And her questions were, what does it take to qualify? What kind of documentation do we need? And I was trying to explain to her, okay, we need to prove that you can keep up your taxes and insurance. And she kept coming back like 3 or 4 times asking more detailed questions about stuff we don't care about, because that's what they're used to, right? A traditional mortgage, you have to prove you can pay back the loan. right? They look at your income, your debt to income ratio, your credit score, your credit history. All of that stuff comes into play because they have to say that Brad is a good credit risk and Brad will pay this mortgage back. Well, that doesn't apply on reverse mortgages, right? All they have to do is say, does the house meet FHA standards and is it going to stay for the next 15, 20, 30 years, however long the life of the loan is? Is the house going to stay in good condition? And can the borrower keep up the taxes and insurance? That's what there's a financial assessment where we look at every person's situation and we say, have they kept up their homeowners insurance? And do they have a history of keeping up their homeowners insurance? Do they have a history of keeping up their property taxes? On their minimal income of $1,700 a month or whatever it is, can they afford to keep up their taxes and insurance moving forward? That's the extent of the financial assessment, right? We don't, did they have, mortgage lates or things like that? We can look at those and see if those are issues. And, credit score is not a determining factor on reverse mortgages. There are things that we look at, but the criteria is when this senior couple is living in this home moving forward, can they maintain the house, keep up the taxes and the insurance? That's what we have to look at financially. There's no credit score, there's no debt to income ratio. Those things don't apply. So it's a matter of three factors: their age, the appraised value, and interest rates. Okay, I'm going to give you the generic answer to that question, which I would have given you any time in the last 20 years, with the exception of the last year. And then I'll answer the question recently. Okay, so if you've got a 62-year-old and a 70-year-old, they base the amount of money they qualify for off the age of the younger borrower because they're based off mortality tables, right? So historically speaking, a 62-year-old would qualify for about 50% of the appraised value of their house. However much it appraises for, they're going to get about 50%. And that's based off of the age of a 62-year-old. The FHA requirements is that one of the borrowers has to be at least 62. If they have a spouse that's younger, that's 60 or 59 or 58 or 18 or whatever, as long as they're married, they can still do a reverse mortgage, but the loan to value, what they're going to qualify for, is going to be based on the age of the youngest borrower. So if they're 62 and 58, even though 62 is the minimum for the reverse, they would lower the loan to value ratio all the way down to the age of the 58-year-old. So it would affect how much they qualify for. That's the standard answer. I usually use a rule of thumb of about 50%. Those were the good old days. Today's market conditions, because the interest rates are horrible, I think right now, the expected rate on reverse mortgage is about 6.5% when they're usually at about 4.5%. So in today's market conditions, they're qualifying for about 33% of the appraised value, whereas normally it was about 50%. So that's kind of the big swing. Right now, I get just as many phone calls today as I did a year ago, as I did the year before that. I have just as much interest in people doing the reverse mortgage. The problem is I have literally hundreds of people that qualified at 50% that don't qualify at 33%. And so when the interest rates go back down again, those people will then qualify. But under today's market conditions, they don't because of that. Now, the flip side of that is there are proprietary reverse mortgages. There are reverse mortgages that plug the holes of where the traditional FHA loans don't go. So some of them will go down as low as 55. Some of them you can do non-FHA approved condos. So they kind of open up the door to other options that the traditional FHA loan doesn't do. They're not particularly great products as far as the interest rates are like over 9%. I mean, they're pretty ugly. Closing costs are really minimal because there's no mortgage insurance because it's not FHA approved. But in a lot of situations, they're a really good program. The one I was talking about earlier today, that's closing today, it's a $5 million house up in Washington State. The traditional FHA loan wouldn't have made any sense there. We wouldn't have gotten enough money. But with the jumbo products, the proprietaries, it made all the sense in the world for him. So, yeah.
Okay. So I've also heard that you can qualify if you're 55. What are the guidelines on that?
Yeah, so those are the proprietaries where it'll go down to, you have two 55-year-olds, they'd be able to do it. Same concept as the reverse mortgage, except the FHA product, it's higher closing costs, lower interest rate, right? You have to pay mortgage insurance up front. The interest rates are a lot lower. Um, the proprietary product, even the 50 that goes down as low as 55, the closing costs are really small. No mortgage insurance, third party closing costs are pretty cheap. Um, but they self-insure those loans. The companies that offer those proprietaries, that's why the interest rates are like 9.5, 10%. They're making their money back up in the interest on the back end of the loan. So they're still securitizing it. They're making up the money. They're just lower closing costs, higher interest rate versus higher closing costs, lower interest rate. But like I said, there are some of those, and I've probably got 2 or 3 in the works right now of people that are under 60 or they're non-FHA approved condos. And so there's still a niche for those. They're just not terribly popular.
Got it. Got it. And the types of reverse mortgages, I feel like I'm asking all the questions here, Jamie, so feel free to chime in. But the type. So look, you can do it just standard for the loan itself, but then what about pulling cash out or an equity line that's on top of it, or a monthly annuity? How do those work?
So typically there's one of 2 things that usually happens. The generic answer to that question is they can take the money out however they want. There are 2 types of reverse mortgages: adjustable rate, fixed rate. Okay. The fixed rate is wildly unpopular. And I say wildly unpopular. I'm not sure with exactly the percentage, but I want to say it's somewhere about 5% of reverse mortgages are the fixed rate because they require a lump sum distribution. You got to take all the money out right away. That's how they guarantee the fixed rate's never going to change. Most people don't typically have a need for that. The adjustable rate has the different options on how to take proceeds. So you can take monthly installments, you can take a line of credit, you can take lump sum. There's much more flexibility on how to use the proceeds. That's what the vast majority of reverse mortgages are. It also typically qualifies them for a little bit more money. The key factor on that side of it is the line of credit. The line of credit is this awesome byproduct that wasn't quite what FHA was planning, but now people are totally taking advantage of it. So, okay, so prior to 2017, people, like I said, the amount of money you qualify for is based on your age. So if you're 62, you get X percent. If you're 63, you get a little more. If you're 64, you get a little more. So what clients would do is they'd say, well, I'm interested in doing the loan, but why don't I just wait a year or 2? And then I'll get a little bit more because then I'm qualified because I'm a little bit older. When FHA said, okay, well, we see people pushing it off and we don't want them to have to do that. So we're going to create this line of credit and we're going to give the line of credit a growth feature. So whatever money is in the line of credit is actually going to grow. What they're ultimately doing is giving you credit for getting a year older, and they're unlocking a little bit more equity for you. But they decided to give it a percent. They said, okay, we're going to let this line of credit grow 0.5% higher than the interest rate that the loan is getting charged. So at the time, when interest rates are 4%, 4.5%, the line of credit was growing at 4.5 or 5%. Not too bad, right? That's not today's market. When interest rates are at 7.5%, the line of credit's growing at 8% interest. So suddenly, that's why I talked about, I teach a class for CFPs. So suddenly, that line of credit growth feature is a phenomenal tool. People who own their homes free and clear, millionaires that don't have, all they want to do is leverage. They don't have an immediate need for the money, but they want to leverage the asset. So they open up a line of credit and then don't touch it. They just leave it there and they just let the line of credit grow. And it is a hedge against inflation. If the housing market tanks down the road, they've got this line of credit that has sat there and grown for 5 years, 10 years, 15 years. They don't need to access it. If they never borrow it, they haven't borrowed anything, so nothing to pay back. But if they need to access money down the road, they've got this great big financial security blanket that's just been sitting there for years, just continuing to accumulate and allow them to access more equity and more equity and more equity. Even if the housing market tanks, the line of credit will continue to grow. So again, FHA didn't quite think through that 0.5% on the loan amount and what would happen if the interest rates went really high. So does that line of credit. So it wasn't meant to do that, but people are just kind of like, that's kind of a cool tool, you know?
Yeah, that is.
So I'd love to kind of switch gears a little bit because we've gotten into quite a bit of the nuts and bolts of the options for reverse mortgage. We've dispelled a couple of the rumors out there and the old information a lot of consumers have. One of the things that, Brad and I and you, we've all been in this industry, not to date ourselves, but we've all eclipsed
years.
2 decades, all of us, and then some. Something that has always been really important to me as an originator is becoming a master of my craft. And I'm very involved in the broker community. I see so many folks in our industry dabbling or asking questions of their peers of the reverse mortgage. And this is concerning to me because we are working with a complex financial picture.
Yeah.
And we are dealing with a client base that is largely in their golden years, may or may not be technologically savvy simply due to the generation that they came up in. To your point, we may have some folks that come from the Depression era who hate debt and need even more of a deeper explanation of why this tool is actually beneficial to them. Taking away the fact that we can all probably agree that unless you have become a master of this craft, you should probably not attempt to give someone a reverse mortgage unless you understand the product. What advice would you give to originators who are listening to this and say to themselves, I would really love to help seniors. I would really love to educate myself and become good at this product. What would you tell them to do as a first couple of steps?
So I appreciate that point. I appreciate you bringing that up. I've changed my tune about this over the last couple of years. To be perfectly honest with you, I liked playing in my sandbox and I wanted everybody else out of it, right? Especially if they didn't know what they were doing. This is too complicated of a. It's not that it's a complicated program, but you are talking about a program geared specifically toward a protected class. If you don't know what you're doing, get out. That was my old tune. I've changed my tune a little bit, and I'll tell you why. So first of all, you're right. Because of the current market conditions, people aren't buying houses the same way because financing is difficult. People aren't refinancing as much. There's a lot of traditional mortgage companies that are trying to stay afloat, and they're starting to kind of dabble into reverse mortgages a little bit. And yeah, that worries me a little because a lot of them are not terribly well educated with them, and it makes me nervous about people getting the rest of us in trouble because they don't know what they're doing or they're doing it wrong. And I think that's the old school mentality of lifers like myself that I'm like, don't touch the reverse mortgage, leave it alone. This is our industry. I'm changing my tune on that. And here's why. If someone who's been if one of you guys decided today, hey, I'm done doing forward mortgages, I really want to get into the reverse mortgage space exclusively, you would be a little bit embarrassed about our side of the industry. And it is so antiquated. Like we don't have any of the cool tools and CRMs and origination software and apps on your phone. The reverse mortgage industry is 15 years behind the forward mortgage side. And so there really isn't very good. There are a couple of exceptions. There really isn't very good information out there about reverse mortgages at all. So if you're a forward mortgage guy that works for XYZ, mortgage broker, and you want to get into reverses, where do you go? Like there really isn't a whole lot of good sources out there. Christina Harms does a coaching, and she knows her stuff. There's very few that do. Honestly, it's so that old adage, those who don't know, teach, right? Those who can't produce coach. I would not say that's the case. Christina is I think it changes that perspective. She knows what she's doing and she can coach people how to do them. I'm very good at originating, not a terrific coach. That's not my area of expertise, but moving into this industry, in order for the reverse industry to change, and in order for it to get updated, and in order for reverse mortgages to become a part of mainstream, we need the forward side to get into this side of the industry. We need those mortgage companies and mortgage brokers. We need big, big players to get into the reverse mortgage space, to bring us up from the antiquated systems that we've been using. Honestly, we just got into a web-based origination software about a year and a half ago. Like that's how far behind the eight ball we are. because they had one company that was the 800-pound gorilla that had their origination software, and everybody had downloaded on their hardware, and it was ridiculous. But
And
that's
people
how slow
still resisted the change, right?
I'm that
People,
guy.
and you're one of those people.
Right. I was that guy. Like, I'm not changing. Why would I do that? I've used this one for 17 years, and all of a sudden I switched. And I was like, why didn't I do this earlier? Anyway, that's our side of that industry is so slow and antiquated that we are not up to speed. We are not up to date, and we need innovators. We need entrepreneurs in the reverse mortgage industry to make it better and make it more mainstream. So I want mortgage companies, forward mortgage companies, banks, credit unions. I want them to get into the reverse mortgage space to make our side of the industry better. They need coaching, they need training, they need experience. Most of the investors, and when I say most of the investors, I mean Mutual of Omaha, Finance of America, Longbridge, SmartFi. Those guys are pretty good sources of information, but you have to understand, as an outside originator getting into the industry, all of them are looking for captive originators.
Sure.
All
Absolutely.
of them want they want you to send there is not a whole lot of very good generic third-party information that will tell you, here's the event. Here's when I use Mutual of Omaha. Here's when I use FAR. Here's when I use Longbridge. Here's when I use SmartFi. There are advantages and disadvantages to all of them. I like all of them a great deal. I've got good relationships with all of them, but there are advantages and disadvantages to all of them. A mortgage broker getting into the business, first thing you got to do is whoever's giving you the information, like anything on social media or wherever else, what's the source? Where are you getting your information from? The person who's talking to you, what do they know about reverse mortgages? If it's XYZ wholesale operation that just started doing reverse mortgages 6 months ago, you're probably going to get limited information. If you get into one of the big players that have been doing reverses for a long time, understand they're still only going to give you 75% of the information out there because they're going to give you enough to originate loans with them. They're really not giving you all of the reverse mortgage information.
Yeah, I think you're completely right. And I think that you bring up a great point when it comes to the coaching. We're very fortunate, as we've had a division called Reverse Loan Solutions as an offshoot to our parent company, AmeriFund, for some time. And Christina, who's been a friend of mine in the space and a fellow, leader, a female leader in the community, we connected a while ago, and we share that same belief that this is a very special protected class of people who are, from a philosophical standpoint, very near and dear to us, and we want to protect them from predators. But also that as we all reach different stages of our long careers in the industry, we often find ourselves asking, what are we leaving? What kind of a legacy are we leaving? So it's also, for me, about educating people so that when I am no longer on the front lines of this, I feel confident that there are other people that are equipped to serve these consumers the way that they deserve to be served. So I agree that coaching is excellent. I also agree that almost all of the reverse lenders out there have some sort of training and guidance, whether it's from an AE specifically or actually through a module.
Right.
What we did with Reverse Loan Solutions that's been very successful for a lot of our originators is we created like a mentorship and a training program where, whether you're a forward originator or you're just a new originator, you learn how to bird dog a potential reverse mortgage. You might be talking to a customer that you think is a forward customer, and through a series of discovery questions that we're equipping you to know to ask, you might uncover the fact that the reverse mortgage is more viable, or it might be the only viable option wherein a forward wasn't, helping a consumer to make a life-changing decision that's going to benefit them.
Right.
So I think that teaching people how to bird dog them is critically important. But then I think nothing in any module can ever give you the kind of practical experience that you need. And I think that you got to start doing them with an experienced person alongside you to make sure you're doing it right.
100% agree with that. Because I'll tell you, I have not had a lot of success converting a forward mortgage loan officer into doing reverses. And the reason for that is because they're selling a product. They're selling a product, right? They're used to, here's my client, here's their credit score, here's their income, here's the product, the program in which I can fit them into. That's not this. The people who are really good at this tend to be insurance salesmen, financial advisors, people who sit down with the client and say, okay, tell me where you're trying to go and let me see how I can help you get there. They're
Yeah.
benefit selling,
That's
because
it.
the selling the specifics of the program is one thing. That's not, this is a very different demographic. And selling to this consumer is very different than selling rate and term to a client. And I'll tell you, a lot of times, even still, some reverse mortgage clients, they don't even know what questions to ask. All they ask is, well, what's the interest rate? Because that's what they're used to. Mortgage, well, what's the interest rate? That's not the case with these. And I'll tell you, these are not, there's a reason that reverse mortgages have a very long shelf life. They take a long time to process. A very good forward mortgage producer may close 15 loans a month to 20 loans a month. A good reverse producer may close 3 loans a month, and they may make the same amount of money.
Mhm.
You
Very
know, I
true.
mean, they're the process of these, they take a long time. You're not dealing with, okay, borrower calls me and says, okay, I'm interested in doing a reverse mortgage. I say, okay, well, let me email you a proposal. I don't have email. I don't use email. Okay, so, well, let me mail this to you. I've sent it to your PO box, because they drive 45 minutes out there once a week to get their PO box. Then they get the proposal and say, okay, well, now what do I do? Okay, now we got to get you scheduled to do the counseling, and then we're doing an application, and then they've got to send me back closing or pictures of their IDs. They're not taking a picture with their phone, scanning a copy of their driver's license, and emailing it to some secure Dropbox. They don't know how to do any of that stuff. So patience is paramount when dealing with clients. I will have people, and the other thing is, most of them think in their head, this is the last loan that I'm ever going to have. They're not in a rush. I have a client that I just closed about 3 months ago. We started him 5 years ago.
Yeah.
They take their time. This is their kids are involved, their financial service their advisors are involved. The best type of loan officers for reverse mortgages have a charitable, what's the word I'm looking for? There's a particular a service mentality,
Yeah.
right? That they realize they're not pushing anybody to do anything that will never work. You are not going to work off of your time frame. You can't create some false sense of urgency about rates are going up tomorrow, so we got to hurry up and get that paperwork back. That doesn't work in this side of the industry. It's going to take time. Big producers in reverse mortgages, and I'm talking big producers aren't the same in reverses as they are in forward sides, right? Big producers that do 100, 150 loans a year, right? That's good production for an individual loan officer. Um, they're working on people and loans that they started months and years ago in order for them to be able to push them through the process. The average turnaround time is, and we're getting pretty good. We're a little under 30 days, but it used to be 60, 65, 70 days on every file that came in the pipeline. And so, yeah, it is an entirely different sales tactic when you're working with these clients. And the other thing is, you're also not dealing with them. You're dealing with their CPAs and their kids and their financial advisors and their attorneys. It is not just a transactional relationship. These people will call you for years after you've closed their loan because they're asking questions. You know, you talked before about people that are getting into the industry and they're trying to stay afloat. From a predatory perspective, reverse mortgages are a gold mine for predators.
Yes.
Because they will see that somebody closed a loan a year ago and they'll send out a mailer pretending like it's coming from XYZ mortgage company. And hey, by the way, your home warranty is expiring that XYZ mortgage company did for you when you did this loan a year ago, and you got to hurry up and they don't know better. Right? They see this letter, they see that the mortgage company's name is on there, they think it's coming from them. And I get this phone call twice a week. Hey, Jeff, I got this company, this call about my home warranty expiring. I'm like, that's a solicitation. Ignore it. Look at the bottom line. You'll see the name of the mortgage company. It's not us. There are so many predators on the side of the business. And I think that'll always be the case, but that also gives reverse mortgages a bad name because people tie those together and think that that's who the rest of us are in the industry. And it's not. And the same thing with the forward side. You've got bad cases, bad apples out there,
Sure.
make everyone else look bad. But the difference is on the forward side, you guys have big names. Wells Fargo, Bank of America, big credit unions, big mortgage companies. You have these enormous entities. We don't have that in the reverse mortgage space. So like the credibility, we say, oh, well, we've got Finance of America reverse. And they're like, who? You know what I mean? Or yeah, no one knows who that is. Like we used to have MetLife was in the industry and Wells Fargo was, and Bank of America was, and Financial Freedom was, and, and Countrywide was. There was some big names in the industry that aren't there anymore. And so we don't have the same level of credibility to the consumer as much as we do in the industry.
Jeff,
and I want to circle back a little bit to Brad. I think you have a question too, but a little bit back. We originally started our chat today and we talked about why doing these loans is important to you and why you have a passion for these customers. Would you mind sharing with us? You can just pick one story of any reverse mortgage that you did for a family that was more fulfilling to you on a human level, and why?
Well, I have a few. I have a few hundred that I could probably draw on, but I say that I think the one that comes to mind immediately is my own family. I would be a hypocrite if I didn't believe in these enough to use them in my own family, right? My stepfather was about 25 years older than my mom, and they lived down in Southern Oregon, and he had dementia. And the disease like that, familiarity is everything. If you put somebody into a home that has a mentally debilitating disease like that, and they're unfamiliar with their surroundings, they go downhill really, really fast. So we did a reverse mortgage on the home to pay for in-home care because my mom wanted to keep him in the home for as long as he possibly could. And he was in the house for about 7 years, being able to pay for in-home care. And it gave both him and my mom a great deal more satisfaction in their later years of life. It gave her a whole lot more time with him. Where I know that if we put him into a care facility, statistically speaking, they're usually there. If they're there for more than 11 months, they're not coming back out again. So it gave her years of life with him.
That's great.
That the reverse mortgage paid for.
That's really great.
And so that's just me. That's my own family. Like I tell people, hey, listen, I did it for my parents. They still talk to me. It was a good product. It was a good move for them. But I could give you hundreds of examples of people that not having to make that monthly mortgage payment, having that discretionary income, change their lives. And
I'm sure Brad doesn't mind sharing, and I don't. My late father-in-law was diagnosed with stage 4 lymphoma back in 2011. And at that time, he was still in his home. But it became very clear to us that his medical costs were going to reach a level where making a monthly mortgage payment wasn't going to be possible for him. And he had never even heard of a reverse mortgage. It was the solution for him. And it took us all the way through the end of his life, allowing him to stay in his home. But to take it another step, his estate was in a trust. And let me tell you, that reverse mortgage company was absolutely phenomenal and sensitive and compassionate to us as we had to begin to make the necessary plans to decide what to do with the house. And for reference, my husband being one of the 3 trustees, we refinanced it into a conventional loan, bought out his siblings, still had plenty of equity in the home, turned it into an investment property in all ways, not only for my late father-in-law during his end of life, but also for his kids, which was what was so important to him. He was able to leave them a legacy without sacrificing the quality of the life for the years that he had left. So for me personally, obviously I believe in the product as well.
Yeah.
Right.
Yeah, I think we all have someone of a story like that. I do too. But I want to kind of conclude with this, Jeff. I know that you mentioned earlier that you do CE courses. So when you say you're not really a teacher, you are a teacher. You've taught, right?
Right. I do regularly.
Jamie asked you, how do people that are originating forward loans get into the reverse business? He said, I welcome them. There's too many people that need it now, but we need good people. So if you're okay with it, we'd love to put your information out there. If somebody wanted to get in touch with you and wanted to just get a quick introduction to, how they would make that transition or add the reverse product in the right way to be able to offer it to the right client base, can they reach out to you, and how would they do that?
Sure. Yeah. If there's a way to be able to put my contact information on the thing, I'm happy to be able to help answer questions. I do get phone calls regularly from people all over the country who I have a 45-minute conversation with, and I probably never hear from them again. But I'm here as a source of information. I do want the forward mortgage side to become better acquainted with the reverse mortgages. I want this to be much more of a mainstream product, and I believe that it will be. I believe that it's necessary. I think that home equity has to become a part of retirement planning.
Yeah.
Full
Well,
stop.
we appreciate that you have that servant's heart, and we will definitely put your contact information below our post. And then Jamie has a question that she likes to pose. It'll be the last question for the day here.
Sweet.
To really make you think. Okay, so you don't know that this is coming, but she's gonna ask you this question. We'd love to get your answer.
All right.
So, Jeff, if you had an opportunity with all the life experience that you've amassed to sit down with your younger self, say Jeff at age 19 or 20, what would you tell him?
Wow. I have a 19-year-old, and I have a son that's 18 that is eerily similar. I'll tell you, in all of my experience in the industry and in a profession elsewhere, part of the thing that I get back from the reverse mortgage industry is I work every day with people that are older and smarter than me and have years and years of more experience than I do. And I say that I've learned a great deal of wisdom way beyond my age because I was willing to listen to people around me that were willing to give me information. And so every day I get to talk with clients that are 60, 70, 80, 90, that have years and years and decades of experience more than I have, that are willing to share with me their knowledge. And so 19-year-old version of me, I would hit him in the side of the head with a 2x4 and say, listen to people around you. Listen to the advice that people who are more successful are willing to provide you, and stop thinking you know everything.
I think
Very
that's
good.
incredibly powerful. One of my favorite sayings in life is that we have one mouth and two ears for a reason. We need to do a lot less talking and a lot more listening in life and in business. So, Jeff, really appreciated this talk. I think it's a wealth of information for loan officers out there, for seniors out there who may not even know that this is a great product for them. But also, we dispelled some myths today, and I think that that's really powerful for our industry. So thank you again. Can't wait to see where you're at in a couple weeks' time here, and we really appreciate you coming onto our show.
I appreciate it. Thank you for the questions. I feel, I've done some TV interviews, I've done some podcasts, I've done some things like this before, and I'll tell you, I appreciate the thoroughness and the depth of the questions and stuff that you guys ask. Like, it's not just superficial. Like, we want people to ask you these questions just so that you can hurry up and answer it. So we've got more, content to throw out there. But I appreciate the depth of the questions and the sincerity of the things in which you're asking, because honestly, not everyone does that, and I think it adds a lot more to what you guys are trying to accomplish. So I appreciate you guys, and I appreciate your questions.
Right on. Thanks again, Jeff. Appreciate it.
Of course. Thank you.
Get Real 411 is hosted by Brad Rice and Jamie Kavanaugh, produced by Stuart Jellin, and recorded live from the AmeriFund Home Loans studio in Simi Valley, California. You can learn more about the show at getreal411.com and watch full episodes on YouTube. If you're interested in being a guest on Get Real 411, email booking@getreal411.com. Please subscribe, rate, and review us on Apple Podcasts, Spotify, or wherever you get your podcasts.